Imagine for a second that you are running a business, right?
Okay, on my phone.
And you just posted this massive 28% jump in revenue. I mean, the money's just flowing in.
Which is an incredible quarter. You'd be thrilled.
Exactly. You'd be to pop in champagne. But then you look at your balance sheet at the end of the quarter, and somehow your free cash flow has just evaporated by 90%.
Wow.
Yeah, it's just gone.
I mean, that sounds like a catastrophic accounting error or, a management team that suddenly decided to just set cash on fire.
Right. Well, welcome to the reality of Meta's Q2 2026 earnings.
Yeah, it's a wild situation right now.
It really is. And looking through our stack of materials for this deep dive, we've got, a comprehensive collection of over 10 recent financial reports, analyst notes, institutional data, all covering this Q2 2026 performance. And Wall Street is completely split down the middle on this.
Oh, absolutely fractured.
Right. Because you're looking at a company that is engaging in a staggering $145 billion spending spree on AI.
Yeah, the scale is just hard to comprehend.
So our mission today, for you listening, is to decode this massive divide. Is this jaw-dropping gamble a genius strategic moat that just guarantees Meta's dominance for the next decade?
Yeah.
Or is it the next Metaverse-style black hole that's going to completely destroy shareholder value?
And we really have to emphasize that the market is just completely split on this. I mean, the division in these analyst notes is fascinating because the numbers themselves are so extreme.
Right.
You really have to start by looking at the sheer volume of this missing cash to understand why investors are either, panicked or thrilled. Because the core advertising business is objectively healthier than ever.
Oh, it's a machine.
Total revenue for Q2 hit $60.8 billion. That's that 28% year-over-year jump you mentioned. And operating cash flow sat at a massive $31.9 billion.
So the core ad engine is humming along perfectly.
Humming, yeah, but then
you hit that free cash flow line.
Exactly.
And free cash flow plunged to just $784 million.
Which is just a stunning drop.
It really is.
Yeah.
And that 90% drop is, it's entirely driven by CapEx, capital expenditure.
Yeah.
Meta raised its 2026 CapEx guidance to somewhere between $130 billion and $145 billion.
Right.
They're taking all that cash generated from this amazing ad business and just sinking it straight into concrete and silicon.
And I think you have to think about the actual physical reality of $145 billion in CapEx.
It's not just software.
No, not at all. This isn't just paying developers. This is massive land acquisition. It's building brand new sprawling data centers. It's securing dedicated power grids.
Nuclear deals, right?
Yes, literally nuclear energy deals just to cool these centers down. Plus buying, hundreds of thousands of next generation GPUs.
Wow.
It is arguably one of the largest corporate infrastructure buildouts in the history of the tech sector.
And that sheer scale, that's exactly why roughly 38% of the analysts in our sources are just hitting the panic button.
Oh, the bears are terrified.
Right. The bears are having severe 2021 Metaverse flashbacks here. They are looking at this CapEx surge and seeing a total collapse of capital discipline. But what really seems to have spooked the market this quarter, the real trigger, is that the management team flat out refused to give clear CapEx guidance for 2027.
Right. And markets simply cannot price endless uncertainty.
They hate it.
They absolutely hate it. By refusing to cap that 2027 spending, management has essentially opened the door to fears of an endless burn cycle. And, you have to put this in the context of Meta's peers.
Okay, like who?
Like Microsoft or Amazon. If they commit $100 billion to data centers, they're doing it with the backing of hundreds of billions in long-term enterprise cloud contracts.
Right, they have a guarantee.
Exactly. They have Azure and AWS clients lined up, ready to buy that compute power for the next decade. Meta doesn't have a traditional cloud business to underwrite this raw compute spending.
Okay, let's unpack this with an analogy because I want to make this really relatable for you listening.
Sure.
It feels like a homeowner who is making, say, $100,000 a year, right? But they choose to spend $99,000 on a massive kitchen renovation.
Right.
And sure, the house will be nicer. The kitchen is going to look amazing. But can you survive on the leftover $1,000?
It's a huge risk.
And I have to push back here because if management refuses to give a 2027 spending forecast, how can any investor comfortably predict when this cash burn cycle will actually hit bottom?
Well, you really can't with absolute certainty. That's the bear sentiment, perfectly encapsulated right there. Can the business stomach this massive transitional phase?
Yeah.
But, you have to look at the other side of the trade, too, because the bulls are looking at the exact same financial reports and seeing a historic opportunity.
A strategic moat.
Exactly. They view this as a temporary but highly necessary investment cycle,
Yeah.
mostly spanning, 2026 to 2028. To them, Meta is building an unassailable AI fortress.
And they point straight to the balance sheet to back that up, right? To argue that they can absorb the hit.
Yeah, the balance sheet is a fortress itself.
Because Meta is sitting on $90.3 billion in cash against $83.7 billion in debt. So they're in a net positive cash position.
Right.
Which means they can fund this crazy build-out without taking on, catastrophic company-ending leverage.
Exactly. The whole bull thesis relies on the idea that this pain is transient. They model out this heavy capex dropping off sharply after 2028. And at that point, the free cash flow is expected to just explode upwards, backed by this far more efficient AI-driven machine.
But look, to understand if this spending is justified, we really have to look at whether these massive AI investments are actually generating any real revenue today.
Yes.
Which brings us to this great monetization divide. Investors might forgive a massive $145 billion cash burn, but only if they see immediate proof that those new servers are making money right now.
Right, they need to see a return.
So are they? Is this AI actually paying off?
Well, the data on this is really the bull's absolute trump card. AI is not just some, theoretical future for Meta. It is supercharging their core ad engine right this second.
Right, the Advantage Plus tool.
Yeah, exactly. Let's look at the Advantage Plus AI ad tool.
Yeah, the sources show Advantage Plus has already hit a $75 billion annualized run rate.
Which is massive.
And they have 9 million small businesses actively using these AI creative tools. But it's the performance metrics that really stand out to me. The AI-driven algorithms have explicitly boosted Facebook ad click-through rates by 8.3% and actual conversions up 15.7%.
And I have to stop you there because that 15.7% jump in conversions is just a staggering leap in the advertising world.
It's huge.
To understand how that happens, you really have to look at the mechanics of the AI. Before these tools, an advertiser would, manually upload a few variations of an ad, guess the right demographic, and just hope for the best.
Right, throw it at the wall and see what sticks.
Exactly. But now, the AI is dynamically generating tens of thousands of ad variations in real time. It's matching specific color palettes, video edits, and ad copy to individual user behaviors instantaneously.
Wow.
It has basically moved the platform from demographic guessing to hyper-personalized predictive targeting.
And they are feeding that predictive engine with the behavior of 3.6 billion daily active users across their family of apps.
Yeah, the scale is unmatched.
That is a proprietary data moat that pure cloud companies simply cannot replicate. They have the closed-loop feedback of billions of humans scrolling, lingering, clicking, and buying,
Right.
which trains these models better and faster than anyone else.
That data moat is absolutely undeniable. But, and this is a big but, the bears are not convinced that just boosting ad conversions is enough to justify $145 billion in server infrastructure.
Really? Even with those conversion numbers?
Yeah, because they point to the structural limits of what they call indirect AI monetization.
Okay, here's where it gets really interesting. When bears talk about indirect monetization, isn't that just a polite way of saying Meta is permanently trapped in the advertising business?
That's essentially it.
Like they built a massive AI power plant, but they are their only customer plugged into it. They're just optimizing their internal network.
That is the exact anxiety driving the bear thesis. Compared to Microsoft again. If Microsoft sells Azure AI services to, say, a multinational bank, they get a direct check for that service.
Right, cash in hand.
Right. It's a clear, scalable transaction, direct revenue. Meta, on the other hand, is just using its AI to make its own ad space marginally more valuable. And the bears argue that Meta's second curve of direct AI revenue, things like Meta One subscriptions, WhatsApp business agents, enterprise APIs, that stuff is still in its infancy. It is way too early to rely on those tools to offset this massive capex.
So if I'm an investor looking at this, why shouldn't I value an AI that just makes users click on sneaker ads on Instagram the exact same way I value a Microsoft AI that is literally running the back-end operations of Fortune 500 companies?
Right. It's a totally different business model.
It seems like they're just an ad agency now.
And the analysts pushing the bear narrative agree entirely. They view Meta as fundamentally an ad agency with an incredibly expensive tech habit.
Wow. A tech habit.
Yeah. But, the bulls push back really hard on that framing by pointing to the margins. Advertising, when it's optimized by AI at this scale, has historically unprecedented margins.
Okay, how so?
Well, you don't have to build custom enterprise software solutions for thousands of different clients. You don't have to manage complex cloud security or maintain a massive enterprise sales force. You just make your single global ad engine more efficient.
Oh, I see. It scales infinitely with practically zero marginal friction. You
Exactly.
just tweak the algorithm, and suddenly 3 billion people are 15% more likely to buy something.
Yes. So the lack of direct enterprise revenue is definitely a point of friction for their valuation, but the raw efficiency of the ad model is undeniable.
Right.
And this exact tension between a wildly profitable, proven ad business and highly uncertain future enterprise AI revenue, that is the core contradiction that is tearing Meta's stock valuation apart right now.
And that contradiction brings us straight into the third part of our deep dive today,
Uh,
the valuation tug of war.
yeah, this is where it gets tricky.
You really have to decide if this stock is a deep discount just screaming to be bought or a classic value trap. Let's look at the headline numbers for a second. Meta is currently trading at a forward PE of only 17 to 19 times.
And for context, that is significantly below its 5-year average of 21.4 times. It also makes Meta markedly cheaper than its mega-cap tech peers.
Like Apple or Microsoft.
Right, Apple, Microsoft, Alphabet, they're all trading higher.
So on paper, it looks like a total bargain. But if you are an investor evaluating your portfolio, you have to unpack the Q2 earnings miss that triggered a lot of this recent volatility in the first place.
You really do.
The EPS came in at $6.18,
Right.
which officially missed Wall Street expectations.
Right.
But when you dig into the underlying financial data in our sources, you see that number was heavily distorted.
Oh, completely distorted. It was almost entirely driven by one-off costs that masked the actual operational health of the company.
What could that cost?
Specifically, Meta absorbed a $2.4 billion legal settlement hit in Q2, alongside another $1.18 billion in severance costs tied to restructuring.
Ah, so it's not that the core business is deteriorating. It's that they absorbed massive isolated financial hits in a single quarter.
Exactly. And when you strip those one-off expenses out of the equation to look at the actual run rate of the business, their operating profit grew by 9%.
Wow.
The underlying cash generation is significantly stronger than the headline EPS miss suggests.
And this hidden strength, that's why a staggering 61.5% of the analysts in our research stack remain solidly bullish.
Yeah, they love it.
For them, this is a rare, almost generational setup. You have a massive company growing revenue at nearly 30%, trading at a PEG ratio of just 0.92.
And a PEG ratio under 1 is incredibly rare for a mega-cap tech company.
Right, usually they're priced way higher.
Exactly. It implies the stock is fundamentally undervalued relative to its expected earnings growth.
So the bulls see this as a historical bottom. Some of the models in our sources have price targets reaching over $1,100.
Which is a massive upside.
Right. They are modeling this huge jump, operating on the assumption that free cash flow will violently rebound by 2028 once the heaviest phase of this data center build-out is finally complete.
But the bears have a very compelling counter-narrative to all that optimism.
Of course they do.
They argue the low PE ratio is absolutely justified. They do not see a discount at all. They see a required risk premium.
They see warning signs that the market is finally pricing in.
Yes. First off, the ghosts of the metaverse are still heavily dragging down the balance sheet.
Oh, Reality Labs.
Right. Reality Labs, the division responsible for the VR and AR hardware, is still burning through $4.6 billion every single quarter.
$4.6 billion every 3 months, with very little commercial traction to show for it so far.
Exactly. It is a massive ongoing drag on overall profitability. Add to that the fact that user growth is naturally plateauing. Global daily active users only increased by 3%.
Right, because when a platform reaches 3.6 billion users, you are simply running out of internet-connected human beings on planet Earth to add to the ecosystem.
You really are. There's just a hard cap.
And if user growth is tapped out, the only way to grow revenue is to squeeze more money out of the existing user base.
Which is exactly why they need the AI to drive ad efficiency so badly. But, there is a ceiling to how many ads you can inject into a feed before the user experience degrades and people just abandon the app.
Yeah, it becomes unusable.
Right. And the bears also highlight lingering tail risks that go way beyond just operations. We mentioned that $2.4 billion legal fee earlier as a one-off cost.
Right. But the bears are questioning if it truly is a one-off.
Exactly. Some analysts are warning that lawsuits surrounding teen addiction, mental health impacts, and data privacy, that those could become a recurring structural cost of doing business.
And, we should be very, very clear here for you listening. We are absolutely not taking a stance on the ethical merits or the legal validity of those mental health lawsuits.
Right. Not at all.
We are strictly looking at this through the lens of institutional analysts who have to model and price potential long-term legal liabilities into the stock's valuation.
Yes. And from a purely financial modeling perspective, the fear is a sort of big tobacco scenario for social media.
Oh, wow.
Yeah, where multi-billion-dollar settlements become a permanent annual line item. In a pessimistic scenario that factors in all of these elements, the unconstrained capex burn, the ongoing Reality Labs sinkhole, and those recurring legal risks bearish analysts actually see a 30.9% downside risk to the current stock price.
Okay, so what does this all mean? We essentially have a market that is looking at a literal money printing machine growing at 28%, but pricing it like a stagnant value stock. Because they are absolutely terrified,
Yeah.
the CEO is going to spend all the future profits on NVIDIA graphics cards and experimental hardware.
That's the perfect summary. It basically boils down to a profound clash of time horizons.
Right.
The short-term view is hyper-focused on the next 4 quarters. Short-term investors see evaporating free cash flow, a perceived lack of spending discipline, and rising legal complexities. They want capital returned to them today through dividends and buybacks. They don't want it sunk into servers for 2028.
But the long-term view looks out to 2030 and beyond. They see a visionary founder who has a proven track record of successfully navigating massive existential platform shifts.
Absolutely.
I mean, Meta survived the pivot to mobile, they survived Apple's privacy changes, and they successfully shifted user attention to short-form video with Reels. Long-term investors see management leveraging this massive 3.6 billion user moat to build the ultimate unassailable AI ad engine.
It really operates as a financial Rorschach test. The data we've analyzed supports both narratives entirely, depending on which timeline you prioritize.
Yeah.
The Advantage Plus conversion numbers definitively prove the AI investments are working right now, but that $784 million free cash flow number definitively proves those investments are just painfully expensive to maintain.
Before we wrap up, I want to leave you listening with a final, slightly provocative thought to mull over. It's something that wasn't explicitly front and center in the standard financial debates over CapEx and PE ratios, but it is hiding right below the surface of everything Meta is doing.
Yeah, the structural implications of their broader AI strategy.
Exactly. We talked heavily about how the bears penalize Meta because they don't have a public cloud business to sell their AI, unlike Microsoft or Amazon. But think about Meta's strategy with Llama, their open source AI model.
Right.
What if Meta succeeds in building the smartest, most capable open source AI in the world, and instead of selling it to enterprise clients, they just give it away for free to their 3.6 billion users through WhatsApp, Instagram, and Facebook?
It would completely invert the expected business model of the entire sector.
Do they accidentally destroy the business models of the very cloud companies the bears are constantly comparing them to?
It's a huge question.
If artificial intelligence ceases to be a premium enterprise product and just becomes a free, ubiquitous commodity that everyone has on their phone for $0, the underlying intelligence loses its premium value. The only thing left of actual monetizable value is the distribution network.
And Meta already owns the largest, most engaged digital distribution network in the history of the world.
They don't need to sell the AI to Fortune 500 companies. They just need the AI to be so good that it keeps you inside their walled garden forever.
Wow. Yeah.
It is a multi-billion-dollar gamble, and how this dynamic unfolds over the next few years is going to reshape the economics of the entire tech industry. We started by looking at a business with jumping revenue and evaporating cash flow. Whether that $145 billion was burned in a panic or invested in a masterstroke is the defining question for the market right now.
Watching this play out will be an absolute masterclass in corporate strategy and market psychology.
Keep an eye on how those 2027 CapEx numbers finally land. Thanks for taking this deep dive with us today.